LLC program is sponsored in part by AIG. For insurance, loans, and retirement, AIG, we know money.
Inside Fort Knox is $56 billion. Try to get in the door, they'll handcuff you on the spot.
American International Group is an American multinational finance and insurance corporation. The corporation was founded on December 19, 1919 in Shanghai, China by Cornelius Vander Starr, and to this very day the corporation is still alive and healthy. So, how did it become so popular? Let's find out. Early years from 1919 to 1945, AIG was founded on December 19, 1919, when American Cornelius Vander Starr established a general insurance agency, American Asiatic Underwriters, also known as AAU, in Shanghai, China. Business grew rapidly, and 2 years later, Starr formed a life insurance operation. By the late 1920s, AAU had branches throughout China and Southeast Asia, including the Philippines, Indonesia, and Malaysia. In 1926, Starr opened his first office in the United States, American International Underwriters Corporation, also known as AIU. He also focused on opportunities in Latin America, and in the late 1930s, AIU entered Havana, Cuba. The steady growth of the Latin American agencies proved significant, as it would offset the decline in business from Asia due to the impending World War II. In 1939, Starr moved his headquarters from Shanghai, China to New York City. International and domestic expansion from 1945 to 1959. After World War II, American International Underwriters, also known as AIU, entered Japan and Germany to provide insurance for American military personnel. Throughout the late 1940s and early 1950s, AIU continued to expand in Europe, with offices opening in France, Italy, and the United Kingdom. In 1952, Starr began to focus on the American market by acquiring Globe and Rupters Fire Insurance Company and its subsidiary, American Home Fire Assurance Company. By the end of the decade, C.V. Starr's general and life insurance organization included an extensive network of agents and offices in over 75 countries. Reorganization and specialization from 1959 to 1979. In 1960s, C.V. Starr hired Hank Greenberg to develop an international accident and health business. 2 years later, Greenberg reorganized one of C.V. Starr's U.S. holdings into a successful multiple line carrier. Greenberg focused on selling insurance through independent brokers rather than agents to eliminate agent salaries. Using brokers, AIU could price insurance according to its potential return, even if it suffered decreased sales of certain products for great lengths of time with very little expense. In 1967, American International Group Incorporated, also known as AIG, was incorporated as a unifying umbrella organization for most of C.V. Starr's general and life insurance businesses. In 1968, Starr named Greenberg his successor. The company went public in 1969. The 1970s presented many challenges for AIG, as operations in the Middle East and Southeast Asia were curtailed or seized altogether due to the changing political landscape. However, AIG continued to expand its markets by introducing specialized energy, transportation, and shipping products to serve the needs of the niche industries. New opportunities and directions from 1979 to 2000. During the 1980s, AIG continued expanding its market distribution and worldwide network by offering a wide range of specialized products, including pollution, liability, and political risk. In 1984, AIG listed its shares on the New York Stock Exchange, also known as the NYSE. Throughout the 1990s, AIG developed new sources of income through diverse investments, including the acquisition of International Lease Finance Corporation, also known as ILFC, a provider of leased aircraft to the airline industry. In 1992, AIG received the first foreign insurance license granted in over 40 years by the Chinese government. Within the U.S., AIG acquired Sun America Incorporated, a retirement savings company managed by Eli Broad, in 1999. Further expansion and decline from 2000 to 2012. Growth. The early 2000s saw a marked period of growth as AIG acquired American General Corporation, a leading domestic life insurance and annuities provider, and AIG entered new markets including India. In February 2000, AIG created a strategic advisory venture team with the Blackstone Group and Kissinger Associates to provide financial advisory services to corporations seeking high-level independent strategic advice. AIG was an investor in Blackstone from 1998 to March 2012, when it sold all of its shares in the company. Blackstone acted as an advisor for AIG during the 2008 financial crisis. In March 2003, American General merged with Old Line Life Insurance Company. In the early 2000s, AIG made significant investments in Russia as the country recovered from the 1998 Russian financial crisis. In July 2003, Maurice Greenberg met with Putin to discuss AIG's investments and improving U.S.-Russia economic ties. In anticipation of Putin's meeting with U.S. President George W. Bush later that year. In November 2004, AIG reached a $126 million, which is $200 million in 2024, settlement with the U.S. Securities and Exchange Commission and the Justice Department, partly resolving a number of regulatory matters, and the company needed to continue to cooperate with investigators continuing to probe the sale of a non-traditional insurance product. Accounting scandal. In 2005, AIG became embroiled in a series of fraud investigations conducted by the Securities and Exchange Commission, U.S. Justice Department, and New York State Attorney General's Office. Greenberg was ousted amid an accounting scandal in February 2005. The New York Attorney General's investigation led to a $1.6 billion fine for AIG and criminal charges for some of its executives. On May 1st, 2005, investigations conducted by an outside counsel at the request of AIG's Audits Committee and the consultation with AIG's independent auditors, PricewaterhouseCoopers LLP, resulted in AIG's decision to restate its financial statements for the years ended December 31st, 2003, 2002, 2001, and 2000. The quarters ended March 31st, June 31st, and September 30th and December 30th, 2004, and 2003, and the quarter ended December 31st, 2003. On November 9th, 2005, the company was said to have delayed its third quarter's earnings report because it had to restate earlier financial results to correct accounting errors. Expansion to the credit default insurance market. Martin J. Sullivan became CEO of the company in 2005. He began his career at AIG as a clerk in its London office in 1970. AIG then took on tens of billions of dollars of risk associated with mortgages. It insured tens of billions of dollars of derivatives against default, but did not purchase reinsurance to hedge that risk. Secondly, it used collateral on deposit to buy mortgage-backed securities. When losses hit the mortgage market in 2007 to 2008, AIG had to pay out insurance claims and also replace the losses in its collateral accounts. AIG purchased the remaining 39% that it did not own of online auto insurance specialist 21st Century Insurance in 2007 for $749 million. With the failure of the parent company and the continuing recession in late 2008, AIG rebranded its insurance unit to 21st Century Insurance. On June 11, 2008, three stockholders collectively owning 4% of the outstanding stock of AIG delivered a letter to the board of directors of AIG seeking to oust CEO Martin Sullivan to make certain other management and board of directors changes. On June 15, 2008, after disclosure of financial losses and subsequent to a falling stock price, Sullivan resigned and was replaced by Robert B. Wilmsted, chairman of the AIG board of directors since 2006. Wilmsted was forced by the U.S. government to step down and was replaced by Ed Liddy on September 17, 2008. AIG's board of directors named Bob Ben-Moshe CEO on August 3, 2009 to replace Liddy, who earlier in the year announced his retirement. 2008 liquidity crisis and government bailout. In late 2008, the federal government bailed out AIG for $180 billion and technically assumed control because many stated a belief that its failure would endanger the financial integrity of other major firms that were trading partners, Goldman Sachs, Morgan Stanley, Bank of America, and Merrill Lynch, as well as dozens of European banks. In January 2011, the Financial Crisis Inquiry Commission issued one of many critical government reports, deciding that AIG failed and was rescued by the government primarily because its enormous sales of credit default swaps were made without pulling up initial collateral, setting aside capital reserves, or hedging its exposure, which one analyst considered a profound failure in corporate governance, particularly its risk management practices. Other analysts believed AIG's failure was possible because of the sweeping deregulation of over-the-counter OTC derivatives, including credit default swaps, which effectively eliminated federal and state regulation of these products, including capital and margin requirements that would have lessened the likelihood of AIG's failure. Illustrating the danger of an AIG bankruptcy, a September 17, 2008 CNN Money article stated, but in AIG's case, the situation is even more serious. The company is much larger and complex than Lehman Brothers, and its assets hitting the market all at once would likely cause worldwide chaos and send values plummeting. Experts question whether there are even enough qualified buyers out there to digest the company and its subsidiaries. AIG had sold its credit protection through its London unit in the form of credit default swaps CDSs on collateral debt, obligations, CDOs, but by 2008 they had declined in value. AIG's financial products division, headed by Joseph Cassano in London, had entered into credit default swaps to ensure $441 billion worth of securities originally rated AAAA. Of those securities, $57.8 billion were structured debt securities backed by subprime loans. As a result, AIG's credit rating was downgraded and was required to post additional collateral with its trading counterparties, leading to a liquidity crisis that began on September 16, 2008, and essentially bankrupted all of IAG. The New York United States Federal Reserve Bank, led by Timothy Geithner, who would later become Treasury Secretary, stepped in, announcing creation of a secured credit facility, initially up to $85 billion to prevent the company's collapse, enabling AIG to deliver additional collateral to its credit default swap trading partners. The credit facility was secured by the stock in AIG-owned subsidiaries in the form of warrants for a 79.9% equity stake in the company and the right to suspend dividends to previously issued common and preferred stock. The AIG board accepted the terms of the Federal Reserve rescue package that same day, making it the largest government bailout of a private company in U.S. history. In March 2009, AIG compounded public cynicism concerning the too-big-to-fail firm's bailout by announcing that it would pay its executives over $165 million in executive bonuses. Total bonuses for the financial unit could reach $450 million, and bonuses for the entire company could reach $1.2 billion. Newly inaugurated President Barack Obama, who had voted for TRP as a senator, responded to the planned payments by saying, "It's hard to understand how derivative traders at AIG warranted any bonuses, much less than $165 million in extra pay. How do they justify this outrage to the taxpayers who are keeping the company afloat?" Both Democratic and Republican politicians reacted with similar outrage to the planned bonuses, as did political commentators and journalists in the AIG bonus payments controversy. AIG began selling some of its assets to pay off its government loans in September 2008, despite a global decline in valuation of insurance businesses and weakening financial condition of potential bidders. In December 2009, AIG formed international life insurance subsidiaries, American International Insurance Company Limited, AIA, and American Life Insurance Company, ALICO, which were transferred to the Federal Reserve Bank of New York to reduce its debt by $25 billion. AIG sold its Hartford steam boiler unit on March 31st, 2009 to Monetary for $742 million. On April 16th, 2009, AIG announced plans to sell its 21st Century Insurance subsidiary to Farmers Insurance Group for $1.9 billion. In June 2009, AIG sold its majority ownership of reinsurer Transatlantic Re. The Wall Street Journal reported on September 7, 2009 that Pacific Century Group had agreed to pay $500 million for a part of AIG's asset management business, and that they also expected to pay an additional $200 million to AIG in carried interest and other payments linked to future performance of the business. AIG then sold its American Life Insurance Company, ALICO, to MetLife Incorporated for $15.5 billion in cash and MetLife stock in March 2010. Bloomberg LP reported on March 29, 2010 that after almost 3 months of delays, AIG had completed the $500 million sale of a portion of its assets management business, branded PineBridge Investments, to the Asia-based Pacific Century Group. Fortress Investment Group purchased 80% of the interest in financing company American General Finance in August 2010. In September 2010, AIG sold AIG Star and AIG Edison, two of its Japan-based companies, to Prudential Financial for $4.2 billion in cash and $600 million in assumption of third-party AIG debt by Prudential. On November 1st, 2010, AIG raised $36.71 billion from both the sale of ALICO and its IPO and AIA. Proceeds went to repay some of the aid it received from the government during the 2008 financial crisis. AIG sold its Taiwanese life insurance company Nanshan Life to a consortium of buyers for $2.16 billion in January 2011. Due to the Q3 2011 net loss widening on November 3, 2011, AIG shares plunged 49% year to date. The insurer's board approved a share buyback of as much as $1 billion. 9 years after our initial bailout in 2017, the U.S. Financial Stability Oversight Council removed AIG from its list of too big to fail institutions. Modern Era from 2012 to 2016. The United States Department of the Treasury announced an offering of 188.5 million shares of AIG for a total of $5.8 billion on May 7, 2012. The sale reduced Treasury's stake in AIG to 61% from 70% before the transaction. 4 months later, on September 6, 2012, AIG sold $2 billion of its investment in AIA to repay government loans. The board also approved a $5 billion stock repurchase of government-owned shares in AIA. The next week, on September 14, 2012, the Department of Treasury completed its fifth sale of AIG common stock with proceeds of approximately $20.7 billion, reducing the Treasury's ownership stake in AIG to approximately 15.9% from 53%. Government commitments were fully recovered, and Treasury and the FRBNY to date had received a combined positive return of approximately $15.1 billion. On October 12, 2012, AIG announced a 5.5-year agreement to sponsor 6 New Zealand-based rugby teams, including the world champion All Blacks. The AIG logo and the Adidas logo, the league's primary sponsor, were displayed on the league's team jerseys. The U.S. Department of Treasury in December 2012 published an itemized list of the loans, stock purchases, special purpose vehicles (SPVs), and other investments engaged with AIG. The amount AIG paid back in the positive return on the loans and investments to the government. The Treasury said that it and the Federal Reserve Bank of New York provided a total of $182.3 billion to AIG, which paid back a total of $205 billion for a total positive return or profit to the government of $22.7 billion. In addition, AIG sold off a number of its own assets to raise money to pay back the government. On December 14, 2012, the Treasury Department sold the last of its AIG stock in its sixth stock sale for a total of approximately $7.6 billion. In total, the Treasury Department realized a gain of more than $22 billion from sale of AIG common stock and $0.9 billion from the sale of AIG preferred stock. The same month, Robert Benmosh announced that he would be stepping down from his position as president and CEO due to his advancing lung cancer. AIG began an advertising campaign on January 1st, 2013, called Thank You America, in which served several company employees, including AIG president and CEO Robert Benmosh, talked directly to the camera and offered their thanks for the government assistance. AIG began an advertising campaign on January 1st, 2013 called Thank You America, in which several company employees, including AIG president and CEO Robert Benmosh, talked directly to the camera and offered their thanks to the government assistance. Peter Hancock succeeded Benmosh as president and CEO of AIG in September 2014. Peter Hancock succeeded Benmosh as president and CEO of AIG in September 2014. While Benmosh stayed on in an advisory role, he died in February the following year. In June 2015, Taiwan's Nanshan Life Insurance acquired a stake in AIG subsidiary in Taiwan for a fee of $158 million. Later that year, activist inventor Carl Icahn called for a breakup of AIG, describing the company as too big to succeed. AIG announced plans for an initial public offering of 19.9% of United Guaranty Corporation, a Greensboro, North Carolina-based provider of mortgage insurance for lenders, in January 2016. Later that year, Icahn won a seat on the board of directors and continued to pressure the company to split up its major divisions. AIG also began a joint venture with Hamilton Insurance Group and Two Sigma Investments to serve the insurance needs of small to medium-sized enterprises. Industry veteran Brian Duppernault became the chairman of the new entity, and Richard Friesenhahn, the executive vice president of U.S. casualty lines at AIG, became CEO. In August 2016, AIG sold off the United Guaranty, its mortgage guarantee unit, to Arch Capital Group, a Bermuda-based insurer, for $3.4 billion. 2017. Brian Duppernault was appointed CEO of IAG on May 15, 2017. Dupperalt, who previously worked at AIG from 1973 until 1994, was hired as CEO from Hamilton Insurance Group. Following Hancock's announcement in March 2017 that he would step down as AIG CEO under pressure after a period of disappointing financial results, due to previous calls in 2015 and 2016 to shrink or break up AIG, Dupperalt announced his intention to grow AIG and maintain its multi-line structure as a provider of life and retirement solutions and non-life insurance, outlining a strategy to focus on technology, underwriting discipline, and diversification. 2017 through early 2019 saw AIG hire a number of new upper-level executives. In 2017, Dupperalt named Peter Zaffino as AIG COO, later also naming him CEO of AIG's general insurance business. Zaffino succeeded Dupperalt as president of AIG in January 2020, with Dupperalt remaining as AIG CEO. The company announced plans in 2017 to reorganize its commercial and consumer segments in general insurance and life and retirement respectively. In September 2017, the Financial Stability Oversight Council determined that AIG was no longer considered a non-bank systemically important financial institution, SIFI. Dupperalt commented in response that the development reflected the progress made in 2008 to de-risk the company. AIG made a number of acquisitions 2018 to 2023. AIG made a number of acquisitions in 2018. That July acquired Valdeas Holdings Limited, a provider of reinsurance based in Bermuda. The company was also a Lloyd's of London syndicate, involved in insurance-linked securities, a specialist in U.S. small commercial excess and surplus underwriting, and a provider of corp insurance. The deal brought in fresh underwriting talent, particularly in property risk and catastrophe risk. Also in 2018, AIG acquired Ellipse, a UK life insurance business from Munich Re. In 2018, AIG established Fortide Re to hold most of its runoff portfolios, and late in 2018 sold off a minority stake to the Carlyle Group. In November 2019, a Carlyle-managed fund and T&D Holdings acquired a majority interest in Fortide Re, leaving AIG with a 3.5% stake in subject to required regulatory approvals and other customary closing conditions. Dupperalt and Zaffino set out a turnaround strategy for the general insurance business in 2017 and began execution. In 2019, Dupperalt stated that the new executive team and restructured the business, implemented new risk and underwriting guidelines, and overhauled its insurance buying strategy. In 2019, Dupperalt and Zaffino announced AIG 200, a multi-year program to improve operations by shedding legacy process and excess manual interventions, modernizing and digitizing workflows, and unifying operations. Also during that month, AIG reported its second consecutive quarter of underwriting profits. And AIG's life and retirement business, led by CEO Kevin Hogan, delivered solid growth and returns despite a volatile credit and equity market. In January 2020, AIG announced it was ending its decade-long sponsorship of the All Blacks in 2021. On March 1st, 2021, Peter Zaffino succeeded Brian Dupperalt as AIG's CEO, with Dupperalt becoming executive chairman of the board. Then, in January 2022, Zaffino also became chairman of the AIG board. As part of AIG's 2020 plan to form an independent company of its life and retirement insurance business with a 2022 IPO, the company announced in July 2021 that Blackstone Group would acquire 9.9% of the new unit for $2.2 billion cash. Blackstone and AIG also entered a long-term asset management agreement for about one quarter of AIG's life and retirement portfolio. AIG's life and retirement portfolio, set to increase in subsequent years. after the spin-off, Corebridge Financial became an independent entity, raising $1.68 billion in the largest U.S. IPO of 2022. In February 2023, AIG and Stone Point Capital entered into an agreement to establish an independent managing general agency and relocate AIG's current private client group to the independent company Private Client Select Insurance Services, PCS. That May, AIG agreed to sell subsidiary corporation Risk Services to American Financial Group for $240 million, as well as Validus Re, including Alpha Cat and Talbot Treaty reinsurance business to Reinsurance Re for $2.985 billion in cash, and Reinsurance Re common shares 2024. In March 2024, British regulators cleared the sale of the UK arm of AIG Ltd to British insurer Avia for £460 million. And there's a history of American International Group. How did it become so popular? Well, I think with all those deals and acquisitions that they've done over the years, I think that's how they become very popular, as they have basically acquired and basically had a lot of companies under their umbrellas for over the years, and we know that from the companies that they are owning, or well, not maybe owning, but under their umbrella are very well-known companies that are still very known and very liked to this day, and people still support those businesses to this very day as well. But anyways, with all that being said, I think I'm going to end off this video. If you guys haven't enjoyed this video, please make sure to hit the like button, and also don't forget to subscribe, because I try and do videos every single day, and also don't forget to subscribe and ring the notification bell on my other two channels as well, including Exotic Game Walkthroughs, where I do walkthrough videos for you guys, where I plan on uploading some new LPs on there for you guys very, very soon. And also don't forget to subscribe and ring the notification bell on my other channel as well, including Exotic Game including Dance Plays, where I upload the RMVs with a swearing in them and some exclusive content on there for you guys as well. And until then, I will see you guys in the next one. Goodbye!